Everybody, you're watching SmallCapSteve Live. I am the SmallCapSteve. It's Tuesday, February 23rd. Markets are totally red. I know everybody in the small cap world is pretty depressed seeing what's going on. We've got a great guest on today, Chris Vermeulen, who's going to walk us through what he's seen from a technical standpoint in terms of the overall broad market. And we're going to get into some specific names. So buckle up. Let's get started. So, Chris, thanks for joining us today.
Hey, thanks for having me on the show.
So let's start at the top here. It's a pretty red day. What are you seeing when you wake up on a day like today? Do you see this much red on your screen? How are you processing it?
It's always interesting to see how the market's going to react. Typically, when I see red across the board, especially when I see the stock indexes down like 1 or 2% like they are today, I know there's going to be a ton of fear in the stock market. People are going to be panicking at the opening bell. And, it's kind of a comforting thought, believe it or not. As a technical analyst, when we have a big gap to the downside like we're seeing today, big selling volume, it's kind of scaring everyone. It's shaking the markets up. But the nice thing is this type of price action is normal. It happens all the time. It's just, people usually aren't prepared for it mentally. So when it hits them off guard, they get really shocked. But we've kind of been seeing this coming. We talked about this, that there's a market correction that's looming any day. We're looking for a 3 to 4% pullback in the market off the highs. And we're seeing that. And the market's washing out. We're seeing panic selling today. So, I can show you some of this analysis on the charts of what the SP 500 is doing. So
let's bring up your chart.
Sure. So if you take a look here, you can see I've got this. This is the 30-minute chart of the SPY, which is the SP 500 index. And more or less, when the bars are green, that means we are still in a technical uptrend. Now, these lime green shaded areas where these spike lows occur, that's when we see panic selling, when we see a lot of selling in the stock market, more specifically on the NYSE. And I like to watch the selling ratios on the NYSE because it's the big board. It's the big brand name stocks where the average Joe trader is holding those big names. It's the first stocks that come to mind when they want to buy into the stock market. It's the first things they want to sell when they get nervous and spook out like they'll be doing today. They're going to sell those brand names. And when we see panic selling on the stock market, which is usually like a ratio of 3 to 1. So there's 3 shares being sold on the bid to every 1 share being bought on the ask. And when the majority of people are selling, that's when we get into these oversold levels. And these lime green are just oversold, panic, emotional moves. And you can see this reaction where we've seen the last 2 trading sessions or 3 trading sessions. We've dipped into this panic sell-off type of market action. We're flirting with the 20-day moving average, which you can see is this green line stair-stepping its way up here. And whenever we get these lime green areas, the market tends to have a bounce. You can see we go bounce and we bounce. We typically get a 1 to 3% bounce, sometimes more. So I think the big gap down today in stocks has got everyone panicking. I think this is going to be a very volatile week. I think there's a lot more volatility to come. We could very easily see the market do what we saw a few weeks back where it gets oversold, it rallies up and crashes even lower the next day and then rebounds again. So people just need to be aware that from a technical standpoint and trading standpoint, we're going to have more volatility this week. We're probably going to see lower prices. And the big question is this going to be like a more significant correction? Something more like we see on the daily chart here, where we saw in last September, where the market goes into a multi-month correction. And that's what I feel is kind of starting to happen here. I think we're starting to see the early signs of that correction coming. It's not confirmed yet, but by the end of this week, we'll probably know if we're going into a much bigger correction going forward.
The interesting thing is, personally, I've been so involved with small caps is I don't even remember that correction at the end of January or the one back in September. So I'm trying to draw on what was happening around that time to may have caused that, and I don't know. But I know you focus primarily on technicals. In fact, you were saying that you don't involve fundamentals pretty well at all. So how has this proven out for you over a number of years, and what led you to that?
Yeah, so it really led to me because when I originally got into trading, it was back in the tech bubble. I mean, you could throw a dart, buy anything, and it would go up. But then eventually, when the markets rolled over and started selling, and we went into that bear market, multi-year bear market, there were stocks that were growing leaps and bounds, great earnings, but the share prices still fell like 30, 40, 50+%. And that was what really something just didn't sit with me. I'm like, this makes no sense. How can this company have quarterly growth, like quarter after quarter, yet their share prices are going down? And you only have to take a few losers like that, and you're like, you know what? To me, this doesn't make sense. The fundamentals don't really power the chart when the market's not favorable. And so I dropped fundamentals and I stuck with the technicals, because the only way we make money as traders or investors is if price goes in our favor. Who cares what the earnings are? I mean, if the charts aren't going up, we don't want to own it. So that's the way I see it. It's night and day. Filter out all the noise of fundamentals, politics, policies. You know, you don't know what's going to hit the market. So what's the point of reading it after it's already hit? It saves so much time and effort, is the way I see it. So I just look at the charts, focus on trading them. And the thing about trading stocks and equities is that typically the stock market is either favorable for stocks or it's not favorable. And so that's what I teach on my website every week in a free webinar, actually, is you need to know when the stock market is favorable for you to own really any stock, penny stocks, sectors, ETFs, leading stocks, whatever it is. If the market's not favorable, you're definitely fighting an uphill battle. Now, the penny stocks have been on fire. Everyone is really kind of piling into those stocks because there's so much potential. It's so exciting. So obviously, sometimes they don't see the pullbacks or pauses that the major stock market does. But more times than not, almost all stocks follow what the broad market is doing. So for example, back last September, we saw a 2-month sideways consolidation. Almost all stocks traded sideways are lower. And you don't want to be in the market when we see this type of sideways price action. Your best is to sit in cash or potentially play some type of option strategy that can take advantage of high volatility where you're selling premiums and you don't really care which direction it goes. It's a directionless, which we do options as well. So you need different strategies for different market conditions. And right now, the market is still in a bull market. We are starting to see signs that the market's getting weaker. For example, if we look at this is a hot list of sectors that I follow. There's a long list of these, but in the last 2 trading days, we've noticed from almost all of these being green, which is this first stage column is long-term trends. We started to see more go into a distribution saying, okay, there's actually some big selling. Big trends are starting to top and roll over. The shorter term trend, we're starting to see some downtrends and some mixed signals. They're popping up. And money is still piling into the risk on, which is the stock market. So people are still investing in stocks. But when we start to see this change, this is when people are moving into utilities, consumer staples. They're moving into bonds, and they're starting to outperform the market, a bunch of things like that. So this is a basket of intermarket analysis. When we see big money rotating into these defensive areas, that's when we really need to be aware, because this can change very quickly. And once the big money is rotating into defensive plays, that means they're not dumping it into the stock market. They're not going to lift the price. We want to follow the big money players. They're the ones that create these big waves in the stock market more times than not. So we're just starting to see a lot of sectors starting to get weaker. And we'll see where the week closes here and how many of these sectors are starting to roll over. This is our early warning indicator that the market's slowly getting weaker and it's rising on fewer sectors in a strong uptrend.
So do you have any media that every morning you wake up, you grab your cup of coffee, you sit down? Do you have any media that you kind of scour through? I know you're not a fundamentals guy, but there must be, like, even if it's Twitter or Reddit or something, things that tell you things you ought to look at.
Yeah. So I've got my normal inbox with, we got thousands of subscribers. So I always get the odd screenshot of a tweet or a link to a post that I look. So it's kind of pre-filtered for me, which is great. It just lands in my inbox. The stuff that people think is interesting with the line of thinking that I'm in. So it works really well that way. But I also like to read, I think it's called the Bloomberg 5 a.m. or 6 a.m. Bloomberg post. It's like 5 things to start your day. That's like headline media. It's like really short and sweet. I think it comes at 5 or 6 a.m. in the morning Eastern time into your inbox. And it gives you an update of what's going on in the European markets, political stuff, what's going on with COVID. That's it. It takes me, 4 minutes to skim through that, read the 4 or 5 points, what the equities are doing across the board globally. And yeah, that's about it. And then I just open up the charts and I look for a sea of green or red or mixed and see how we're going to need to attack the day or manage positions.
Got it.
So how do you prefer to do your trading then? Are you short-term, long-term? Do you prefer the short side, the long side? What's your overall typical strategy? So
typical strategy is to the long side because almost all times we're in a bull market. Bear markets are very short-lived. They're amazing money can be made in a bear market. I do love them when they start. You can make so much money very quickly because prices fall, 4 to 7 times faster than they rise. So you can see a 7-year bull market or 10-year bull market and half of it wiped out in a few months, which is pretty amazing, or in a year. So there's a lot of potential to make money from inverse ETFs or falling stock market prices by, shorting. I do like the long side. I love ETFs. I like ETFs because they're not really wild. You can put in larger amounts of money. You can play these individual sectors. I use a strategy that I call BAN, Best Asset Now. And so I'm constantly rotating into what is the top performing sector right now. And I want to be in those and trade them after they've had some type of pause or pullback and they break to a new high and start a run. So I like those because they're slower moving, which means you can put that more money to work versus a whole bunch of individual stocks that are like popping and dropping every day. And there's a lot more kind of headline risk. You've got news from CEOs, you've got individual company issues that pop up and individual earnings versus a big basket that moves much slower. So I like to catch these kind of intermediate waves that last generally 30 to 40 trading days. So 1 to 2 months in length. I guess you'd call it more or less position trading. It's very casual. It's very easy to track and follow and manage. And then when the market's not favorable, like last September, you sit in cash with that strategy for a month or two, wait for that strategy to give a new buy signal. And then you look for the next top performing sectors to get back in for, this recent rally that we've had. So it's that's my strategy, is ETFs to the long side.
Okay, so let's try to unpack that a little bit. What are the hot sectors that you're looking in?
So right now, if we were to look at there's been a few. The hottest sector right now that's really starting to creep up here is the energy sector. XOP, which is the oil exploration stocks. If this will pull up here, they've been bucking the trend. So we're seeing the industrials, and we're seeing the oil and energy stocks actually trading higher on a day like today. That's why the Dow Jones Industrial Average is actually doing really well. Let's take a quick look just so you get a visual of how these sectors can affect. So if we look at the NASDAQ right now, the NASDAQ's had a pretty sharp pullback, an 8% pullback in the last week and change. And that's because big money right now is actually rotating out of all the recent high flyers, all the big plays like the EV, electrical vehicle market, the solar sector is getting hit. So money's rotating out, and I think it's positioning for a new strong economy. And so seeing money move into the industrials. If we look at the industrial sector, XLI ETF, you can see how this has been trading, sideways and higher over the last couple of days while the stock market's been falling. So money is moving into this sector. People are expecting, the economy to strengthen, and it's going to mean we're going to see these move higher. And of course, the energy sector, XOP, I just showed you, is trading higher. And of course, those are stocks that are in the Dow. The Dow industrials, energy industrial stocks. The Dow's really only pulled back like 1.5%, 2% or so, versus the NASDAQ, which has, come down and broken these previous pivot lows. So the energy sector is definitely a hot sector right now. It's jumped right up to the lead. Obviously, the biggest leader recently has been the MJ, which is the Harvest, the marijuana ETF. It had a beautiful run, which we traded for about a 48% gain. We ended up getting out on this reversal day. A little hard to see here, but we had this huge reversal day. Reddit got in on it. They kind of got everyone to pile in. Everyone piled in right at the top. And I was talking to subscribers early this morning saying, during the morning of, saying this is going to gap open another like 20+%. It rallied about 74% from where we got in. I said, guys, we're probably going to get stopped out on this with our trailing stop today, because we got a 15% trailing stop that's going to get dragged open at the opening bell, dragged up. And if we have this big reversal, like most Reddit plays do, where everyone piles in, they create this massive gap, and then it gets sold into, and then just is a dead trade after that, we're going to get stopped out today. But that's a good thing. It means we're getting out. We're locking in 48% on this, and who cares what happens after it? The trade is done. We need to let it mature and create a new setup. So the MJ was the leader, and now that the media got into it, they've killed it. So it's a done play. And that's what happens with anything. When something becomes mainstream, it's pretty much done. You have the mainstream pop, and then there's no one left to get into it, because all the technical traders were in it early, and then the mass media drives it up for us to get out of it. That's just the way it works. That's technical. That's the markets. So I like the industrials. I like the energy sector as strong plays going forward here.
How do you choose to get out of a trade when, like you're saying, okay, you see a reversal? My psychology whenever I'm trying to get out of anything is, oh, it's already dipped. It's like, if I sell now, I'm selling at the low. How do you avoid that sort of psychology of fear that you're just picking the low?
For sure. So this is the number one problem. The most difficult part of trading is, where do you take profits, and how do you know when to get out? And that's why you really do need a strategy. So the band strategy that I use and I trade with subscribers, we've got very clear set of rules. When we get into a high momentum ETF like the MJ or the EV market ETFs, whatever they are, and the green energy was our last wave, we're looking to scale out of position. So at 7% profit, we sell a quarter of the position. At 15%, we sell another quarter. At 20% gain, we sell a third quarter. And then we leave a runner on for that last quarter in case that sector just keeps rocketing. And because we're trading the leading sectors, they're pretty volatile. And we can see them run 20 to 100+%, fairly common. And so we just throw a 15% trailing stop on that price. So in this case, for the MJ ETF, it's pretty straightforward. As price goes up, our trailing stop starts to chase it up. And then as it sells off 15% from the most recent high, we're going to get stopped out of it. And no matter how much we love it and we don't want to get out of it, you have to sell it, because based on trading the leading sectors, based on volatility and historical performance, when you get stopped out with a 15% trailing stop in a sector, it's usually done for quite a while. It's just kind of statistics, and you're much better just move to cash and go find something fresh that now is ready to pop and run 20, 30% on its own, versus play something that just had an exhaustion blow off top that could be dormant for months.
Okay. So let's talk SPACs for a minute here. SPACs are kind of this new vehicle where you've effectively got a shell that's filled with cash that is looking for a business that it wants to purchase with said cash. And then there's usually this redemption date where those who bought the SPAC or bought into the original placement of the SPAC, they get to choose whether they want to stick in or get out. How do you go about evaluating a trade on a SPAC given this sort of structure?
Yeah, I don't really trade anything that's super new like that. I mean, I don't know a lot about it, to be honest. I mean, I just look at ETFs that are performing, or stocks. I don't like to get into the really tiny micro stuff that's kind of shells and really new, thinly traded stuff. So I can't give a whole lot of insight on that. All I know is you got to be extra cautious, smaller positions than normal. They move fast, which means there's a lot of potential to make money, but there's also a lot of potential risks involved with those. So The only insight I can give you is if it's new to you, you've never traded before, or it's new to the market, trade a small position size.
And that would always be my advice when playing with Canadian microcaps, because these things are usually tend to not trade on fundamentals. There's usually a bunch of bad actors who own a bunch of the shares, and I had a friend who called me this morning about one, and he was all bummed out that he participated in private placement. He's like, by the time the shares even get into his account, which have a 4-month hold on them, so forget about the 4-month hold. By the time the shares he even gets his DRS, he's like, he's going to be underwater. And it's just like, well, what's the fundamentals behind this business that you invested in? Like, you invested in it because they told you they were going to promote the stock. That's usually, like I fully understand and appreciate why people like yourself that focus on technicals, you'd want to avoid those types of vehicles altogether. Because if you're just trying to bet on the ability of promoters to navigate a share structure, I don't know how you assess that. Yeah,
it's tough. I mean, it's, I did a lot of private placements years ago, and I just got sick and tired of it. You get in, you get warrants, you're huge in the money. And by the time you can exercise those warrants, the price is right back down to the warrant price. It's really, really painful. What I've learned is if you find a good deal and somebody wants to do a warrant with you and they got a plan to go, you don't even have to do the warrant. You just go and just buy the stock at the open market, because and then you can sell it at any time you want, right? So why get locked up when you could, the warrants give you the potential. If the thing runs 500%, it's amazing windfall, but it actually barely ever happens. You're way better to just, know there's action going on. There's probably going to be some people in there pumping up the share price. So just go to the open market, go buy 10,000 or 100,000 shares, whatever it is, and then start scaling out as it moves up, and you can take advantage of it without any strings attached, and you're completely liquid at any point, right?
Do you put any thought into who actually owns and again, right now we're talking about microcap, small cap, where this plays a really big role. Figuring out what funds or individuals own shares and unlock dates. Do you look at any of that when?
I used to. So I don't know I used to do that. It's super important. You definitely want to know who's going to help advise them, who's on the board. If there's big money behind it, like some big, billionaire players, and they've got their advisor team that wants to be part of it and make sure, it's going to be kind of set up and run properly. It's all about the team. When it comes to a penny stock or micro company, it really is about the team. People are generally betting on the team. And you need to know the market. I don't know really the market, the teams anymore, or who to really invest in. I kind of am out of that loop. But there is no doubt, if you've never heard of something and you don't know who the people are running it, and you do your research and they're not really found anywhere, I'd be really cautious. Just it's got a lot more risk to somebody new to the market who doesn't have experience going forward. So it is critical to see who's going to help kind of grow that company.
Yeah. Jay, go ahead.
So one thing that's become really prevalent over the last, call it year, 2 years, whatever you want, is options trading. Now options trade on big boards, obviously, and to me, they would definitely impact ETFs. How has that impacted your trading style, or has it not at all?
Options are huge. I don't trade them a whole lot. I've got a guy who, an options expert that trades with us, and he's big into selling premium. And so, for example, you really need to know how to trade options and which option strategies to trade when you're trading. So if you're new to options and all you really know is you're going to go buy a call or a put, the odds are stacked really heavily against you. You need to know a few things when you're trading options. And options are great because you can hedge positions, you can profit from direction. You can be very defensive on other plays. You can do directionless strategies, meaning it doesn't matter where the market is going. It doesn't matter if it goes higher or lower. You can make money consistently, on every 2 weeks or every month by letting these options, by writing and selling premiums. So, for example, if you're looking at the SPY chart that I have up here, there's different strategies you're going to use for different times. So during a high volatility strategy, where a time where the market's selling off, the VIX is starting to spike, there's increased volume, you might want to start selling premium, because now there's this extra price put into the options contract. You can start selling it, and it doesn't matter where the market goes from here. It could keep going lower. It could just chop sideways. So you can sell premium and just totally ignore what price is doing, and just, collect kind of biweekly income. Most of the options expire, or most of the options value is kind of given up, and the theta decay, the time decay in the last 2 weeks of a contract. So if you're to be rolling contracts every 2 weeks, you're more or less collecting a little paycheck, selling this high volatility premium every 2 weeks, and you don't care which way the market goes. Now, once it kicks back into a full-on bull market and everything is firing on all pistons, a nice trend up, you might want to pick something that is potentially still selling a premium but has a bullish bias. So you're making a little bit of money, and if it does continue to move higher, you're going to make even more money. There's all kinds of strategies out there. We even have our own custom strategies that we've developed that take advantage of some pretty unique market conditions, and that's what we offer with to subscribers. Are these different strategies. So there's definitely ways to make a lot of money trading options in all market conditions. And there's two major things you need to know when you're trading options. One is, are you going to be direction, pick a direction, or are you going to be, non-directional? And if volatility is high or low, you need to be on one side or the other for those. And most people are trading the wrong strategy in the wrong market condition. And so if you were to trade the wrong strategy, but actually have the stock move in your favor, you can actually still lose money with options. Whereas if you've got the right strategy for the market condition, that you can make a lot of money in that same time frame with very little effort and much smaller drawdowns. So it makes a huge difference. It's night and day whether you're going to become long-term successful or not. You have to have the right strategy for the current market condition, and the market condition can change weekly. So it's definitely something really important. We're going to be teaching that probably next week for free in a webinar on our website of how to know what strategy to trade for the current market conditions. We've got this massive table that tells you and teaches you how to select the market condition or find the market condition, and then all the different strategies you can trade and how difficult they are, beginner, intermediate, advanced. So options are very powerful, but you need some education in order to trade them properly.
Chris, can I ask about your background? How did you end up becoming like the technical trader? Were you a portfolio manager, or just a retail investor, or a private investor? What brought you to creating this platform?
So I was a portfolio manager in high school.
Okay.
Our finance class, we had to create a portfolio and compete against the rest of our province, which is equivalent to a state if you're American. And so we created this portfolio, and our class had to manage it. And we were all kind of like mini, portfolio managers. And we did really well. We didn't win by any means. But that was when my eyes opened. I think I was 16. And I saw how much money could be made with a $100,000 account. I mean, we turned it into like $400,000 over a semester. We obviously didn't really know what we were doing, but it was the eye opener. I'm like, holy cow. I don't need to have a business. I don't need to work for someone. I just need to scrape up $100,000 and start trading it. And I can do that. So that was how I got hooked. And then through college, I started trading. And I made enough through college to pay for my last year of tuition and residence and books and food and groceries. And that was when I started teaching roommates and the roommates' friends. And so I've been teaching for over 20 years, and it started out as just a school project. And I'm like, this is the business I want to be in. I can work from a computer anywhere and not have to deal with people.
Yeah. Okay. So your platform, it's a subscription model?
It is, yeah. So we've got, it's a subscription model, and we've got different newsletters. So depending if you're a long-term investor, you just want major bull and bear market signals, when to move to bonds, when to move to cash, back into stocks. Really, really simple. We cover all the major ETFs. So if you're with Fidelity, we say, okay, stock market has a new buy signal. Here are the Fidelity funds that you should move into. If you're with, whatever you want it to be, Vanguard or we cover about 30 different major companies. And then we work our way down to swing trading ETFs like the band strategy. We're looking for 20+% return over a 1 to 2 month period. And we get down to options where we trade short-term options that expire in a few days. Not expire in a few days, but the trade may only last a few days to a couple of weeks. So we're pretty active depending on which kind of category you want to fall into, equities trader, options trader, or long-term investor.
Got it. Okay, well, thanks so much for joining us today. This was fun. If investors want to sign up for your subscription account, they go to thetechnicaltraders.com.
Yep.
Okay, perfect. Well, thanks so much for doing this. This was great.
Jay,
thanks
for having me, guys.
Jay, did you have any?
No, my main questions were all answered. It was great. Thank you.
Perfect.
Great.
Thanks so much for joining us, and I hope you'll come back. Once it feels like we're at this point where things may be pulling back in 6 months, we'll be able to point to this video where you kind of called a bit of a turning point here, and it seems like the next couple of days are actually pretty important.
They're very important. I started liquidating some long-term positions I've had because the market is starting to show signs of weakness, and I'm just lightening my portfolio. But it's not here yet, or I'm not jumping. Don't jump the gun. I mean, we're still in a bull market, but if you're overexposed, like most people are, over-leveraged, trimming off, locking in gains, there's nothing wrong with that.
Well, perfect. Thanks so much, Chris. It was great chatting with you.
Thank you very much.
All right, take care, guys. Bye-bye.
Okay, so Jay, let's go through the Canadian venture and microcap news quickly. Let's start off with Hive Blockchain. They purchased 6,000 additional miners, pushing capacity to 1.67. I don't even know what EH is per second.
I knew for about 10 seconds at once upon a time, but I don't know. I just know it's bigger than pH. It's the next level up. So to me, this was a big release that contained no details. We know they're buying 6,000 additional miners. We don't know what type of miners. To some people that matters, some not so much. The core of it is they're adding 444 pH of compute power to current capacity, which pushes them to 1.67. Notably, this is slightly higher than Bitfarms, who this morning announced that they're at 1.18 EH on their way to 1.3 by the end of March. So it seems like these two are in a tight locked race to have the bigger dick, effectively, is really what it comes down to.
Okay. But, Jay's pulling, not going to pull any punches, are you?
That's really what it is, right? We have more computing power. Well, it's not exactly one-to-one in the sense that Hive more so focuses on Ethereum while Bitfarms focuses on Bitcoin. But different currencies, it all comes down to the same thing. They're looking to expand computing power. However, no financial aspects of this release or was included within the release, so it's kind of hard to judge whether it's a good deal or a bad deal, right? I mean, right now, adding any capacity is probably a good thing. I don't know the price of Bitcoin right now. I know yesterday is between 50 and 55,000 US, so any capacity is good capacity.
I might get in shit for this, but I scanned it twice and I couldn't figure out. There's all this excitement about a Skylight Health. Skylight Health? SHG news release today where it said that they're switching their server over to Amazon. I saw all these people on Twitter acting like they now have a partnership with Amazon. So
do I issue a news release when we switch server providers? Who cares?
Yeah,
sure, it might make things a bit faster, but how's that going to impact revenue generation?
Yeah,
genuine question.
Let's read this together here.
I actually saw it and went, "Oh, that's a nothing burger," and skipped it.
Here, actually, let me try to pull up a different version here. This one here's got just too much. It's on Yahoo.
It's on Globe Newswire this morning. If you just want to go there and search it.
Health Newswire. Okay. Expand status strategy.
Some of the most useless information contained within my head is what companies use which news service providers.
You're probably the only person who seems to know. Okay, I'm going to pull this up here.
Pretty much.
Okay, so Skylight Health They expand their data strategy to utilize Amazon Web Services infrastructure to improve patient care, health outcomes, and clinical efficiencies. Does this not just read like they just switched their fucking server? And their previous server was probably
but you're not
using
getting
Amazon.
it, Steve. They're mentioning artificial intelligence, so that means something. No,
So-
it just means that they're using a different service provider. Who fucking cares?
Like this is so Skylight Health, one of the largest multi-specialty healthcare systems in the United States today, announced that it has partnered with Amazon Web Services to utilize their infrastructure and tools as part of a big data strategy. Skylight Health Group will combine data with hundreds of different sources and use tools available in AWS, from business intelligence platforms to artificial intelligence, to identify ways to improve patient care while increasing clinic efficiency and revenue potential. So a whole lot of adjectives here. I'm so Amazon Web Services, they must just, I'm assuming that they signed off on this, probably happy to do so to show that people are using them. It is interesting that Amazon Web Services allowed them to use the word partnered. If they did, assuming they did sign off on this, which I assume that they did. The Skylight Health approach will enable acquired clinics to take advantage of guidance from its centralized team of clinical and operational experts whose insights will be powered by this big data strategy. Aggregating data from its clinics will allow Skylight Health Group to, 1, improve patient outcomes by identifying key marks of health and disease, reduce hospital visits, enhance monitoring, and increase satisfaction and quality of life by tracking metrics that are important to patients. 2, increase patient engagement in their own health by identifying, there's no point in me continuing to read this. Effectively, all it says is what the software does is now going to be hosted on a different server. I assume that that Amazon offers some AI tools that they're going to incorporate. But this is
just like Google Analytics does. I can see where this data is coming from, or
they like Microsoft Azure and AWS, Amazon Web Services. They do offer like certain AI tools that you can incorporate, but it's not. I don't see how this is news release worthy. It's like saying that you like. One of my favorite ones was a company called East West Bioscience, which Jim Rockford famously pumped the snot out of. And they announced that they hired like a delivery company to deliver their food products, which, by the way, never made it into stores. And it's just like, what? You like, then do you actually think that this is going to generate buying? But then I see people like Merida, Mitch, who like, it's generally, I'd like to have him on the show because I actually do think highly of him. But, you know, I guess you can't help it when you're long, but data doesn't magically aggregate into predictive analytics. You need raw data before you can monetize it with the most powerful tools. Portco SHG is on it.
You know, I think I have an issue with some of this stuff, right? To me, healthcare is not something where you try and extract every dollar from a patient for. Like, I'm Canadian, call me, I have a socialist view on healthcare. I don't care. It doesn't insult me. It is what it is. But to me, the whole notion of we're going to analyze this data and try to get more revenue from it just means we're trying to get people to pay more for their healthcare by going, oh, we can classify this service as under this category rather than that category, which makes us generate more from the patient, right? Like, to me, that's not a noble thing, and it's not something I'd be bragging about personally. I mean, I have an issue with it.
My whole issue with this, and I understand what you're saying. They're an operating business. We can spend some time on their financial statements, of which I've never really understood the company. The stock has performed tremendously well, and that's very different than the operating business, which I will admit I don't know enough about to be commenting on, other than looking back in hindsight at the most recently put out financial statements. There's not enough there to get me really all that excited, and I don't understand the current valuation. I see a clinic or two in there that's doing most of the revenue, with one little piece of SaaS business that does generate some revenue.
It's a classic telehealth story in Canada where they're acquiring clinics and trying to get the tech multiple on it, right? Like, there's a lot of companies in the space doing it.
Yep, and they're all like, this is why, like, normally I don't care about technical analysis, but like, I mean, we have to accept that in this market, it's about fast money, and fast money technicals probably mean more than fundamentals, because these fundamentals make no sense. So if
Absolutely, and I don't think people understand the gravity of you saying that, because for the last 3 years that I've known you personally, you've always gone technicals mean nothing. So for you to say that means you've broken down and accepted.
well, when it comes to small cap, micro cap names, in a lot of cases, you're betting on the promote, and like I know that's people don't want to hear that, but that's just the reality,
That's
right?
reality.
A name that we're in that I think is going to catch some life here is Level Jump. I tweeted about them not that long ago. Let me show my tweet here. I can find it. Where is it? And this isn't to say really anything other than Level Jump trading at 2.5 times sales. Comps trading the 15 to 30x range. And it's got a $50 million market cap. We could see here from the income statement of Level Jump, it's at that $6 million revenue run rate. At this point here, and they're a coverage client of ours, so full disclosure there. We're not the kind of promoters who, not that we're a promoter, but we're not really what you're betting on, although some people like to sometimes say that we are. You're betting on everybody who's surrounding this company and their ability to tell this story. But in this environment of price to sales multiples and lots of stocks that trade in that sort of telehealth world, this is the kind of stock that it's trading at like 40 cents or something. I don't know. It's been a shit day, but
38 cents.
38 cents. I could see the stock trading at $1.50 in 6 months. It's just look at this income statement. Look at the shares. I think there's like 40 million shares out, give or take. Can this thing trade at a $60 million market cap? I think so. They're going to have to add a tech component. That's part of the problem, but they haven't really started to. I don't think they've really done. However, all these things are being promoted. I don't really understand that world that well, which goes to show you that how hard it is to invest in this space. Like, we've recently seen some stocks run just tremendously on tremendous volume. And I'm calling people up around the company going, do you guys have any idea where this volume's coming from? And they're all like, oh, I hear that they're hiring this letter writer. And it's like, people are buying it because they're hiring a letter writer? Perhaps that's it, right? Perhaps it's like, you say you're hiring a letter writer, then you call up all your rich friends, and they all hop in the market, and they just start buying, and then all the traders hop in. The next thing you know, you're doing tremendous volume, and the stock runs.
Self-fulfilling.
Yeah, and that might be it. And I'm fascinated enough by it to call people up and ask these questions. But you look at Level Jump's statement, right? You're probably going to okay, well, they only did $42,000 in net income last quarter. Why is this business that attractive? And the answer is if you were putting your own private money into it, maybe perhaps it's not that attractive. But relative to these other telehealth deals that are out there, this is low-hanging fruit for a stock that should appreciate once the right people dig into it. That's my take. And that is why fundamentals just don't really matter that much.
Which pains both of us to say, unfortunately, but that's just what we're operating under, right? You have to adjust for the market, whether or not you like it.
Yeah. So let's get into some other news here. Bragg Gaming. This story is kind of interesting. Bragg Gaming brings in $16 million from forced warrant acceleration. What can you tell us here, Jason?
Yeah, this was just a quick little one this morning. End of January, I think it was January 29th, they announced that they'd be accelerating warrants that I don't even know were free trading yet. They're in connection with financing completed November 18th. Warrants were at $1. The stock is now sitting at $2.77, and effectively they forced the early what's the word I'm looking for? Early expiry of these warrants based on the trading price. So I mean, the company brought in 16 million more. My understanding is that not all of the warrants were actually exercised, and I think that comes down to is people couldn't take money off from the investment as a result of still being under lockup, right? I'm not really a fan of when companies do this because it just makes it so hard for some people to fund the warrant, and effectively they lose money as a result, which isn't necessarily fair to them, right? But that's what happened. 60 million in gross proceeds, and they're looking to use it for increased liquidity and flexibility for future growth.
There's tremendous demand for these sportsbooks names. A client we recently took on is Bets, who I believe that they're going through a name change right now, so I don't even know what the name of the company is. They were originally in with Bilzerian, and ultimately I don't think that he's moving forward with the company, but it's still kind of like, it's still forming, and it's like you look at the balance sheet and it's like, well, who would buy this fucking thing? But then it's like, you look at the comps and go, well, geez, these don't make any sense. So on a relative basis, they got the right people involved. A couple big announcements showing that they're putting the right structure in place. It's interesting. And that's, I mean, when you're in these types of risk-on markets, I think that probably playing the relative valuation game is a pretty good tool for how to assess what names to be in. And in that sense, I think that a company like Bets is a really, really interesting name, because I think that they got the right people involved to transform this thing and have just as much as what all the other guys have, which, as far as I'm concerned, none of them really have anything. Like the Score, which is done tremendously well. Like I
think it's actually been falling since they did their reverse split.
What's the Score trading at?
It's at 38 right now.
$38? Are they going on the NASDAQ?
Yeah, that's what they split for. However, they had a high of 48.50 or so. So they've fallen over the last 3 sessions from that high.
Okay.
So this thing's taken a sharp tumble following the consolidation.
They're on the big board. And yeah, we can kind of see there. Whew. Like the Score has, like, it's kind of like a failed sports app when you like really break it down. Like, there was a time where this app, everybody used it, and then Google just started sending sports score push notifications to everybody's phones, and I assume Apple does the same thing. And then kind of like, wait, why do I need the sports app again? But they've got their gambling connections, and the Score is a stock that fundamentally has never made any sense to me. But now anybody who's able to do any traction or put it together any sort of coherent business plan in this space can do extraordinarily well, because I mean, just look at this. Like this thing's done really well. I don't know enough about the business model to really speak to like what the likelihood is that they actually generate meaningful cash flow. And I can't say that about any of these companies, but it's just such a strange market, because 3 years ago you would have never looked at any of these names and said this is interesting. But in a risk-on market, what does make it a reasonable thought is that there's enough capital flowing in that these companies can actually go and raise real money, and with real money you can do real things. So again, it's a fast money world where technicals do matter, and so does just playing this relative valuation game. Because it's not like, I bring up the sports betting example, but I'd say the same thing about all the telehealth deals. The U.S. cannabis deals, I actually think a lot of them are I can make a fundamental case that they're undervalued, because I see cash flow, I see EBITDA.
Yeah, but I'm already taking the other side of that argument, if I'm being perfectly honest, and I'll take flack for it. That's fine. Why would the U.S. market not turn out like Canada? I'm asking you, like a genuine question. Why would it?
So, in the long run, perhaps you're right, but like understand here that these names that we're talking about, these speculative names in Canada, none of them will probably generate material EBITDA or cash flow. A lot of these U.S. cannabis operators already are, and it's still early stage enough that long run you're probably right. Long run. Yeah, I agree.
I kind of view it like this: like, is Truly generating cash flow right now? Yes, undoubtedly they're. I think there's a leader. Yeah. However, once limited licenses stop in Florida, which I'm no expert on the state by state stuff. However, in my mind, once things go federally legal, I don't know how much control the states are going to have over licensing in terms of we're only having 30 licenses or 40 or whatever that number is. If that ability to protect licenses go away and things are no longer limited license, well, any Joe Schmo can come in and you're going to see a mass fall in the price of cannabis, in margins, in everything. And at that point, Trulieve might be the market leader right now, but if things go fragmented, how do they perform long run? Right? Mm-hmm. I'm just using that example. I mean, that's kind of how I see it. I don't know the high level of how things are going to play out legal-wise, obviously, but that's just a major risk I see that no one seems to be taking into account.
But this is material, material revenue, right? Like you've got Trulieve in the trailing 12 months has done over $100 million of operating cash flow, right? A lot of these names that we're talking about, these speculative names in Canada, I'll bet you none of them ever come close to $20 million in operating cash flow. Trulieve's already doing $100 million. They've got real operating team in place. 3 years from now, could they be doing $300-400 million? Yeah, I do think that there's going to be a commodity trap, but we do know one thing: retail investors love cannabis stocks. So, and you're going to see a lot of these fund managers aren't necessarily. I'm not going to say that they're not smart, but they fall into that sort of their knowledge turns into a mile wide and an inch deep. So I think that puts us in a place where you're going to see a lot of them get trapped into these things in 3 or 4 years when Trulieve is generating $400 or $500 million in EBITDA, and go, yikes, look at this thing. It's going, not really understanding the commoditization thesis that you're talking about that happened in Canada. In Canada, we went straight to commoditization, right? Like,
we went there because everyone overbuilt, expecting things to be much larger than they were. So, I mean, right now, I kind of question if that's what's going to happen stateside. So, is it possible? Yes. Is it possible I'm entirely off base and completely fucking wrong? Absolutely.
So you got to understand too, like the characteristics of the market is nobody's building huge facilities in the U.S. because it can't cross state borders. So everyone's, they're building in line with where they see the market. And understand too that in Canada, everybody was building these huge facilities because that's what investment bankers told them to do. Right? Like a good friend.
Absolutely. There's a lot of stuff different. But I mean, at the same time, are you going to continue to grow cannabis in a greenhouse facility or an indoor facility in Michigan or New York or any of those northern states? Or are you just going to grow it in California and ship it out?
You know what? The margins are lucrative enough in enough of these states like Michigan. I've driven around Michigan. I've looked at operators and assets. It's like you can get buildings cheap enough, and there is enough margin in cannabis for it to make some sense to like grow in Michigan for the time being.
I'm also talking under a commoditization scenario, so that margin would be depleted significantly. But I still understand the premise of what you're saying.
But the bigger thing is that, look, at some point, certain states are going to be where the stuff gets grown. Like probably, I don't know, like North Carolina sounds like a state that's probably interesting, and anywhere sort of in that sort of Northern California sort of like.
Yeah, I mean, you're going to have grows on the East Coast and the West Coast because for a time or for a long time, who knows, it may not make sense to ship everything from California. You're also opening yourself to a lot of risk in the event of a wildfire or drought or whatever. We already know there's water problems there. But I just mean like these far north states, I don't understand why you would want to build a ton of grow capacity there right now. Like Illinois.
Like Kentucky, right? Like Kentucky, I would imagine would be a great state to grow tremendous amounts of cannabis. And isn't Kentucky a big tobacco state? But, yeah. Hey, look, what I'm getting at, though, is in the short run, so if we're talking the medium term, like, 3 to 7 years type thing, I don't see cannabis crossing state borders. I think that this is just, it's too messy. I don't think that you're just going to have a switch get turned. Politically, it's too messy. This is just my opinion. And what that's going to do is that's going to make it so that certain operators are going to hit it big in certain states, like Trulieve did in Florida. And some of these states are big, like, like Florida's 2/3 the size of Canada. Same with New York, and New York's hardly like the legal cannabis market in New York. It's nothing. It's nothing. So there's going to be tremendous opportunity. You're going to see some operators in this 3 to 7 year range, in my opinion, generate some real meaningful EBITDA margin, and couple that with some fund managers that are believers and a ton of retailers who are believers that now have access to Robinhood, NASDAQ, NYSE. I think you're going to see this like so much capital inflow into the U.S. cannabis space that it's going to be like a face-ripping type move.
Yeah.
Trulieve could trade it relative to today's valuation. Trulieve $1,000 relative to today. Can Trulieve be a 20 bagger? I think so.
Yeah. So I mean, one thing to consider. I mean, in terms of access to the U.S. market, we've already seen GTI, who today closed another $56 million U.S. after closing on $100 million earlier this month under their their Form S1 registration statement. But one thing I always consider too is the notion that the markets are forward-looking. Are they forward-looking? Yes. Everyone right now is buying Trulieve going, in 5 years, 10 years, they're going to be able to generate XYZ revenue, which is X times today. Or sorry, Z times today, whatever you want to use. However, that forward-looking aspect, to me, it never seems to appropriately consider the risk of an event like commoditization, right? So while I'm sitting here going, long run, it's not going to work, that's not going to be baked in. In my mind, that will not be baked in because the market does not forward look in that manner. It doesn't appropriately discount the risk. Instead, they just look at the potential for growth. That's exactly what happened in Canada, and I expect the same thing will happen in the U.S.
The challenge I have when thinking about the broad market and small caps and capital inflows into all these risk-on environment is that, and you've heard me rant about this multiple times, is that like if we look at the real estate market, where real estate in Canada just keeps going skyrocketing. Well, you can't build more houses. I mean, you can. It takes years to do it. There's zoning and a lot of capital required. Blah blah blah.
Infrastructure, yada.
To create deals that you get to tell a big story around, that's not hard. Like we could sit around. We could have a powwow, create one of those, what's that thing everybody's hopping on right now? It's like a new social media platform every day. There's some new one. Clubhouse. We create a clubhouse with a bunch of our audience. We come up with 10 ideas. We do whatever we have to do to get around the rules to get these things publicly traded. The next thing we know, we actually have some success with just these ideas that we have, and we suck $200 million out of the market. Well, that $200 million is probably going to get incinerated now, and it's not going to come back. So what I'm getting at is there's only so much risk capital, and it will start to go away. So how we play this from here, is it a flight to quality? As some of these names start to get exposed, do we start to see short sellers come back in a big way where they start to expose these things? Like in this risk-on environment where capital has been employed, okay, we were having a bad day. I need us to have like a bad, probably 2 weeks where the market, like the broad market, gives up like 30% for me to start to be like, okay, perhaps this is the end. But how do you navigate this? That's something we're going to be covering every day, trying to figure out like is it a matter of flight to quality? Or is it a matter of like just get the hell out because these things are all so overvalued that like there's just no fundamental argument to own any of these things?
Absolutely. I mean, we addressed it earlier a bit with Chris, I believe, but the whole notion of this whole craze for SPACs, that is sucking up so much risk capital that it makes it hard for these small cap operators who actually have some form of business. I'm not saying all do, but some genuinely do. The iguanas of the world, right? We know that every day there's people in an office pushing that company forward, and there has been for years. It's a genuine operation, which you don't always get in a small cap, which is what I think a lot of people don't understand.
So let me follow up with this question, and then we'll wrap it up because you probably got to go pick up your son. Do you think at some point in the next 6 months we see a SPAC take out a Canadian microcap? I say yes.
I would love for it to be Iguana, if I'm being perfectly honest, because I think that I do not know Iguana like the way you do, and I will never, ever suggest that I do. But to me, Iguana or someone like them is a genuine candidate for something like that. Whether or not it happens, I don't know the intricacies of effectively a SPAC taking over an already public issuer. I don't know how well that would work unless it's just
I'm sure it's possible.
Acquisition. But I don't know that a SPAC could directly do it.
Why not?
Because a SPAC's the purpose of taking something public. Something's already public there, right?
I don't know. It's a special purpose vehicle. I don't know that it's necessarily special for taking something public. This is obviously beyond our pay grade. We're just a couple of retail investors speculating here. But in such a scenario, if something was allowed, or maybe it's some company that's about to go public, and they go, as part of our acquisition, we're bringing you in, and it's not the sole asset that's going public. I can see an instance like that, right? Like, maybe it could happen. I mean, there are quality names out there that are small cap. One thing I will say is look at all the actual gold producers still on the venture exchange, right? I know gold has kind of fallen out of favor, and it's bounced back and forth and all around. But there are genuine producers that are on the venture exchange, right? And they're there for one reason or another, and there's no reason that they can't go up. But would a SPAC be interested in that? Probably not, because there's no fancy, desirable multiple to get from that. However, I'm just saying that there are quality names on the venture that are often underappreciated. Yeah, well, this like the whole reason I asked the question is there's no secret that there's just too many SPACs, and they're all seeking good deals. Like in Iguana is the perfect name to bring up, because look, there's 4 companies who make home batteries who are allowed to hook up their batteries to the grid. Iguana is one of them. So this is a story that if they were just a private operator with all their partnerships, and the SPAC were to take them out, I bet you that they'd be taken out at $500 million.
Or more, absolutely, just because that's the market we operate in.
And now, obviously, like there's 300 million shares out. So, like, if a SPAC wanted to take them out here at 500 million US, it's going to be about $2 a share. And I don't even know that the company would entertain that. Like, you've got a lot of like pretty wealthy groups that are in Iguana that have been in it for like 5-6 years, and I don't think that they're in it to get taken out for $500 million. But it's awfully hard when your stock was traded at 7 cents that long ago, that if you're offered $1 to $2 a share, to be like, we're gonna say no to that.
Yeah, absolutely.
But we'll see. I think that there are too. I think somebody said, I forget just the amount of SPACs that's going, but there's going to be a deal quality issue with the SPACs at some point.
That's already there. How many cannabis SPACs are out there that have gone with tech names or space names or everything else? We hear about it constantly, right? And that's because, sure, there might be a lot of private operators out there. It doesn't mean they're a quality operation, right? Mm-hmm. It's a struggle, and I mean, everyone wants their billion or multi-billion-dollar valuation for the SPAC that they started and they put together so that they can walk around and flaunt it effectively. But there's just not that many private operators out there, dependent, like, across all segments, right? To me, if I had a company that I had built privately that was generating cash flow of $100 million a year, I have zero reason to go public. To me, that's the worst thing I could do, because right now, if I'm one of, say, 20 shareholders, I'm just dividending that out year after year to myself and our shareholders, right? Like, why would I give that up?
Yeah. Okay. Well, look, let's wrap it up here. What's going on at the dive this afternoon?
This afternoon, we've got Spot Gamma on the daily dive. Brent goes over some more of his Gamma talk, which is great as always. On top of that, I believe we had TPCO go out just before we went live. Another analyst is on the company, and we had young Justin cover it. On top of that, we've got some macro about debt to GDP going out in about an hour and a half. And I don't know what I'm going to wrap up this afternoon with yet. So time will tell, and we'll see.
Okay. Well, if you are tuning in, we are not financial advisors. Nothing we say is a buy or sell recommendation. If you're looking for that, go seek somebody who's licensed, not a ding-dong like myself or Mr. Jay Lutz. We appreciate that everybody took the time to join us today. You could have spent your last hour staring at any screen any place in the world, but you chose to spend it with us, and I sincerely appreciate that. Tomorrow we got Mike McGlone coming on from Bloomberg, assuming that Restream agrees with us, which it didn't last time we tried to have him on. So, which we're pretty excited about. This guy's a Bloomberg analyst and knows Bitcoin extremely well. So, if you got any questions about Bitcoin, tomorrow's a good time to hop on and go on YouTube, Twitter, whatever platform we're on, and ask some questions because this guy knows Bitcoin thoroughly, and I'm pretty excited to get to chat with Mike. So that's it for today. I look forward to joining you all tomorrow, and I hope you guys enjoy the rest of your trading day, and perhaps we get a little less red. All right, thanks, guys.